In September, the Fed cut rates by 0.25%, which led to the media speculating, will the Fed continue to lower rates? Will they raise rates? Will they keep them the same? Now, historically, the media and the experts have been notoriously bad at predicting where interest rates will go, which leads to the question for stock market investors. When rates go up, when rates go down, when rates stay the same, how can you expect that to impact your stock market portfolio? And in today's video, and it's going to be a quick one, I'm going to share with you how does the stock market perform on average when rates go up, down, or stay flat. And then you can use that as a tool to think about it when you're watching the news with people predicting where interest rates are going. Okay, so let's look at a few quick bar charts here. So when rates fall by more than 1%, the stock market has, on average, for the last 50 years, given us about a 1% monthly rate of return. Okay, so that's pretty good. When rates are falling, when they go down by more than 1%, stock market's averaging about 1% a month. What happens when rates rise by 1% or more? Well, when rates rise by 1% or more, the market's average about 1% per month. Okay? Well, what about when rates don't rise by a lot and they don't fall by a lot? Right? When they're between +1 and -1, so they're not necessarily rising or falling, they're staying pretty consistent. You may have guessed where we're going in this video. The stock market over the last 50 years has averaged about 1% a month. Whether rates stayed roughly the same, went up by more than 1%, went down by more than 1%. And so as we're hearing the media and whoever talk about where rates may or may not be going, while that might have certain financial implications when it comes to stock market investing, it does not have a strong correlation one way or the other to drive the markets up, to drive the markets down. These seem to be relatively independent, especially when you look at long periods of time and you look at the averages. And so what's the takeaway? The takeaway is this is one less thing to pay attention to when it comes to your stock market portfolio. And as I always say, you should know what you own and you should know why you own it. Hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.